second. Okay, just started recording.
All right, Dean, thank you very much, and go right ahead.
Okay. Hello, everyone. My name is Dean Liu. Today I'm going to present a super investor presentation. As you can see, my presentation topic is value investing. It is a simple but not easy investment strategy, as you will see as we will go over this presentation. So first, this is an overview of this presentation. First, I'm going to talk about the value investing and what is value investing. What are the things we often mention when we talk about value investing? And then I will go and choose 8 super investors, and then to construct a super investor index. And after that, I will compare the performance of super investors with the market and to see whether the super investors can outperform the market. And in the end, there will be some discussions and personal views of this presentation. So first, what is value investing? Value investing is an investment strategy or philosophy that we invest in stocks that is trade for less than the intrinsic value. In a simple way, it would be you go out and buy cheap stocks. So here, cheap stock doesn't mean you go out and purchase stocks that is traded at $1 per share or $5 per share. It is the market value of the stock is less than the intrinsic value, which is the actual value of the stock. That's what value investors are looking for. And according to Benjamin Graham, who developed the value investment concept, and it is called margin of safety. And it should be at most 33% of the intrinsic value. So, for example, if intrinsic value of the company is about $100 per share, then the market value of the company should be at most $66 per share for the value investors to invest in that stock. And so how do we calculate intrinsic values? So there are many ways to add value in the company. One of the ways is called a discounted cash flow analysis, which basically you use the concept of time value of money, and then you go on to run the fundamental analysis to analyze the company, the industry, and the overall economy to estimate the future cash flow, the discount rate, and the growth rate of the company. Once you have these 3 figures, and then you'll be able to calculate the intrinsic value of the company. And then you compare the intrinsic value of the company with the market value and see if there's opportunity to invest. So there are several things we often mention when we talk about value investing. The first is growth investing. So for the value investing, value investors, they are investing stocks with margin of safety. So the key is the margin of safety. For the growth investors, they invest in companies with high growth potential. So because they believe the stock market, the stock price of the company is directly linked to the company's future growth. So if the company is expected to grow in future, then the stock price of that company will also expect to grow. So the key here for growth investors is the growth rate. So because they are focused on the different things of the equation, the intrinsic value equations, so they are different. One of the articles I read today talked about the difference between value investing and growth investing. In author's opinion, they are in a sense the same. It is not because Warren Buffett once mentioned growth investing and value investing are joined at the hip. The author's opinion was because they're all about the investors' expectation. So for value investors, they invest in stocks with low expectation, which usually indicated by low PE ratio, low price-to-book ratio, and high dividend yield. So, and they believe because the expectations are too low, and then factors causing the stock to be undervalued are only temporary in nature. So once those temporary conditions pass, and then the expectation will increase, and which leads to the increase in the stock price. And for the growth investors, they invest in stocks with high expectation already, which indicated by high PE ratio and low dividend yield. So, but because they believe the company will grow in future, and then compared to the future expectations, the current high expectation are future low, and then the same logic as the expectations grow from high level to even higher level, the price of the stock will also increase. So if we see this question from the investors' expectation, and they're in a sense the same strategy. And then the second thing we often mention is the efficient market hypothesis. It is basically asserts that the financial market is informationally efficient, and then it has three major versions. The first one is the weak form. Basically, it claims that the price of the ending traded security has reflected all the past information. So there's meaningless for investor to identify any trades or patterns using historical stock price data. And then the second form is the semi-strong form. It claims that the price will reflect all the public information, and then it is subject to instant change when the new piece of information becomes available. And for the strong form, it claims that the price will not just reflect the public information, but also the private information. So in a sense, it says the investors cannot consistently beat the market for given all the available information. However, as we all know, that super investors such as Warren Buffett can consistently beat the market over the last 20 years. So which suggests that the efficient market hypothesis might not hold true. Actually, there are several assumptions that this hypothesis was based, and one of them is investors are rational and they are risk averse. But as a human being, investors are not always rational. Then they become greedy, and then they might do crazy things, go to invest in stock that does not make sense at all. So that's the second thing we often mention when we talk about value investing. The third thing would be the modern portfolio theory. And it is a theory that widely used in today's financial industry. And it attempts to maximize the portfolio's expected return for a given amount of risk, or to minimize the portfolio's risk for a given amount of return. In other words, a modern portfolio theory is trying to create an optimal portfolio. So it states that by carefully choosing the proportion invested in each individual asset in a portfolio, the investors will be able to reduce the risk of the portfolio. If we look at the chart on the right, we will see that. Hello?
Hello?
Yes.
Yeah, so I was wondering, so do the super investors in your index tend to go with more risky portfolios, or do they tend to go with less risky, and how do the returns translate?
Well, they tend to have lower risk, and they can generate even higher return than the optimal portfolio, as we will see later in the comparison of performance. So for the portfolios with different proportion investing individual assets, they will have a different risk and a return. And all such portfolios defines a region. If we highlight the left boundary of that region, we will have efficient frontier. So for portfolio that is only efficient frontier means it either has the highest return for a given amount of risk, or the lowest risk for a given amount of return. So in other words, they are all optimal portfolios. And that's the case where portfolios does not include any risk-free assets. So if the investor decides to invest in stock market and also the risk-free assets such as U.S. 10-year Treasury bond, and then the efficient frontier becomes a straight line, which would be the best possible asset capital allocation line here. But in either case, the optimal portfolio will be on the efficient frontier line. But as we will see later in a comparison between the super investing index and the market index, the super investing index will be able to achieve even higher return and with the same amount of risk. So they will be able to outperform the optimal portfolio, which is pretty amazing.
So do actual super investors use the modern portfolio theory?
I believe they do, even though it does not always hold true, because in theory, the optimal, the best they can do is it will be on this efficient frontier. But they have to find a way to allocate their capitals. So I do believe somehow they believe